Welcome back. As you know, I'm Michael Carr for Banyan Hill Publishing. We're now on part 3 of our educational series, How to Read a Stock Chart 101. And this is where we really explore how to put what we've learned to work. In this part, I will cover just how to spot price patterns using the building blocks of trends, support, resistance, and gaps that we discussed in the last video. Now, patterns can be broadly categorized. We have topping, bottoming, and continuation patterns. But before going through general ideas of what patterns are, let's look at one in depth, and that'll help us understand this whole concept. One of the most popular patterns is the head and shoulders top. This has been widely followed for years. It's been first documented in the 1930s. And subsequently it was studied in the 1990s by the Federal Reserve. And what the Fed found was that you could profitably trade the head and shoulders pattern. And what it shows us is the market is topping. Now, it gets its name from the fact that roughly it looks like an individual's head and shoulders when we look at it. So here's the pattern on a chart, the shoulders, the head. It basically consists of 3 peaks, the first and the third being the shoulders, the middle being the head. And what's nice about this pattern and other patterns is that we can develop a price target. That really helps us to develop a trading strategy, as we'll look at in the last video in this series. Now, the left shoulder and the head are simply a normal uptrend. What we have is higher highs, higher lows. That's the left shoulder. The head, we don't know it's a left shoulder until we see the right shoulder forming. What we have at this point on the chart is a normal uptrend. Then the uptrend fails to make a new high. That's when we draw our pattern. Then we have the right shoulder and what's called the neckline, where we connect the lows of the shoulders. The right shoulder is marking the failure of the uptrend to reach a new high. And then the neckline shows a change in psychology. Remember, we had an uptrend. After we fail to make a new high and we break below that neckline, which is the lows of the shoulders, psychology shifts among traders. We no longer have an uptrend, we now have a downtrend. What's important to remember about this is any traders who bought as the pattern was forming now show a loss after it breaks below the neckline. Some of them are going to immediately sell, and that tends to lead to a rapid sell-off after the neckline breaks. It's really that simple. The head and shoulders is an uptrend that fails to continue, and then anybody who bought as that pattern was forming, in this case it took a year to form, anybody who bought during that year shows a loss. Many of them are going to sell, and many of them are going to push prices down as they sell. Now, like I said, we can get a measured move out of the pattern. So what we do is we take from the neckline to the highest high, and we project that lower after the break. There's a sense of symmetry in technical patterns. So the technical analyst believes that anytime you can identify a pattern, you can assume there will be a symmetrical move based on that pattern. So we simply measure the depth of the pattern from the high to the low of the pattern, and we project that from the breakout. Now, digging into some patterns. Topping patterns, head and shoulders the most famous, but there are others, and let's take a look at some of those. Here's another head and shoulders. This one's not as precise, and again, that's important to remember. As we mentioned in the last video, precise rules make it impossible to trade patterns. You have to have some flexibility, get the general idea, and develop a trading strategy. You can develop a trading strategy that manages risk and targets a precise level of reward. So there's no need to be precise in the pattern, since you're building the precision in to the risk management and the profit taking. But here we see a looser pattern an uptrend, a breakdown, a looser shoulder, but we still get the breakdown. And what we see here is as prices fall below the neckline, I've added volume to this chart, volume spikes. That's all those traders who bought here selling because they now have a loss. So the volume shows that the head and shoulders concept works exactly as we would think it would. The V-top is a sharp pattern. Prices race up and race down. That's psychology. That's nervousness. Traders are nervous when we see these V patterns forming, and we tend to see large moves develop from that. Now, V-tops are especially common in commodities like oil and gold. And what happens in gold, for example, as gold prices race up, the psychology becomes one of fear of missing out. Traders like the idea of gold going to all-time highs, so they rush into the market. When it makes a brief pullback, they tend to rush out of the market because futures are highly leveraged. So here was oil, rapid run up here over 3 months. Once it falls, traders who bought here have a loss, and in futures markets, your loss can be rather large since you're in a leveraged market. You're using borrowed money to buy some of that. So the collapses after a V-top in commodities tend to be rapid, and it takes a long time to recover. So when you spot a V-top in gold or oil, don't expect a rapid recovery. In the stock market, it shows excitement. There could be a rapid recovery. Commodities like oil and gold, completely different. The double top is the idea of resistance that we talked about in the second video in this series. We have prices rallying higher. That's an uptrend. Normal pullback. They fail to break through resistance. We can then look and say, here's our interim low, draw consolidation, develop our price target, and watch for breakouts. So this is where the double top highlights where we're beginning to see resistance and support come into these patterns quickly and easily. The triple top, just like the double top, except it goes a little bit longer. We have the uptrend, then we have traders worried that prices don't break out to new highs, and we get the rapid decline. The rectangle is a consolidation pattern. It doesn't tell us much about direction because it's simply a consolidation, but it does tell us once we get a breakout to expect a move that's equal to the depth of the pattern. So we take the low and the high in the pattern, we measure that, count how many points it is, and then subtract that from the breakout on the downside. If we had an upside breakout, we would add that number of points to the upside. For a stop loss, use the midpoint of the pattern. That gives you a precise level of trading. Now, the rounding top is an imprecise pattern. We have basically a top that's ill-defined. It's not quite a triple top because we have the uptrend. It's not a head and shoulders because the third top is higher than the second. So again, just draw your consolidation roughly, measure your price range, in this case about 3 points. When you get the downside break, expect a fairly quick move of 3 points. And it's that sense of symmetry that is more important than the name of the pattern. In all cases, we just want to be able to identify a region and project a target. Now, this is a conservative target. This is a more aggressive one. The target drawn on the right side uses closing prices, and then the actual highs and lows from the spikes develop a more aggressive target. It's up to you. If you're an aggressive trader, use the spikes that are outside of the consolidation to develop your target. If you're more conservative, use the closer range. Bottoming patterns include a V bottom, double and triple bottom, and let's look at each of those in turn. V bottoms tend to be fairly common in the stock market. we just get that panic selling. This is March 2009, and sellers were panicking, just get me out. Well, eventually the last panicked seller gets out, and then markets stop falling and then rally sharply. And we can't always tell exactly where the actual bottom is. Looking at this chart, in October of 08, we had a V bottom that was short-lived. November, we had another V bottom. We had multiple V bottoms form. Ultimately, one of them was the significant bottom that marked the end of the market. However, anytime you spotted a V bottom, you had the opportunity to get in anticipation of it being the bottom, and using a stop loss halfway in the formation of the pattern, you had a level of knowing where you were wrong, and it was time to get out and take the next trade. The double bottom is roughly a W pattern. So maybe you could think of it as two V's, but you have the wide-ranging W. Once you're able to identify that, you have the concept of support coming in, where traders who miss the opportunity to buy here are buying here when prices get back down to there. You can then look and see where the W forms, look for symmetry, find your price target, place your trade. Triple bottom, just like a double bottom, except that we have that third down move. So here we had prices fall, prices rallied. When they fell again, individuals who failed to get in at the first low think it's a bargain level. They buy, they push prices up a little bit, and it's a relatively rare pattern where you get another chance to buy near the lows. So the triple bottom tends to, when it breaks out, tends to be a very effective pattern because you have so many buyers coming in on support. Different analysts can call patterns different names. You could call the highlighted area a rounding bottom, a double bottom, a rectangle bottom. Again, it doesn't matter. You have that sense of symmetry. You have the price target, and that's what's important about pattern analysis. Patterns can be useful for trading. You can see them on any style chart you use, and we reviewed chart styles in the first part of this video series. Names are less important than the fact that once you see a pattern area, you can project a price target, and you can develop a trading plan assuming that if prices move halfway through the pattern area, the trade is wrong. The signal is negated, and you have your stop loss and your profit target. That's the end of our third video, where we learned how to trade different types of price moves. I hope you enjoyed watching this edition of How to Read a Stock Chart 101. In the next part of my series, I'll walk you through making a trade so you're completely comfortable and confident doing it on your own. So stay tuned.